Hello everyone and welcome to the Week in Markets. I'm Chris Leyland, Director of Investment Strategy. I'm delighted to be joined by my fellow Investment Director, Kevin Kidney. So Kevin, we're coming up to the end of the quarter. We're all looking forward to a nice relaxing bank holiday weekend, but maybe just before then, let's just start with thinking a little bit around what's been happening within macroeconomics.
So I think if we look back to the end of last year, it was the US which was driving a lot of positive sentiment into the end of 2023. We know that last year, but mostly 2022, it was inflation worries and inflation outcomes which were dominating markets and the returns from asset classes, both equities and bonds. I think what we've seen now is a clear transition from inflation worries to growth optimism. And that growth optimism isn't just being led by the US. There's now clear signals of breadth. And one way we measure that is we look at economic surprise indices. So that's where data month to month comes in, but it's better than expected. And we are seeing clear trends, particularly in this month, March, that the UK is now seeing the most number of economic surprises. So data coming in is stronger than expected. And that's a nice, neat handover from the Eurozone, which was leading for most of the quarter. So very elegant growth transition from the US leading at the end of last year. The Eurozone has clearly bottomed. We know that Germany was in a technical recession at the end of last year, and this is now feeding into the UK. And the UK, of course, entered a technical recession, but that's been very mild. Clear signs now that the UK is set for some positive growth outcomes. And that is good for market returns. And this is where I think where you and I have been discussing equities, and it'd be interesting to hear from you what's been the most interesting outcome in markets based on these growth outcomes.
Yeah, I think firstly, it's been a really positive quarter. Hopefully, clients watching this, you will have seen this come through in your returns. But maybe just digging into that a little bit. So if we look at MSCI World, so that's basically world equities, that's up in sterling terms around about 10% overall. I think, one of the things that we were talking about earlier was, what's maybe surprised us over the quarter. And there's probably two things that have surprised me. So I think the first thing that surprised me is we came into the year with, I think, 6 interest rate cuts being priced in the US. And then what you've seen is those interest rate cuts start to be priced out. So I think there's 3 that are being priced right now. And previously, when that would have happened, probably actually would have experienced quite negative moves in equity markets if we think back to last year. But actually this year, what you've seen is equities have been really resilient. You've seen strong earnings come through. And really that's helped deliver those good equity market returns. And then probably the second thing for me is, one of the things that we discuss quite a lot is regional performance, and probably the region that we discuss the most is the US. And we've seen incredible performance come through from the US, and particularly a handful of stocks within the US overall. But one thing that I think has actually been quite nice for the year to date is actually starting to see performance broadening out. So you're starting to see equity market breadth come through overall. So instead of just having a concentration of stocks that are doing very well, what you're seeing is that's broadening out overall. So I think for me, pretty positive around what we've seen. It's been a really good quarter overall, and I think there's lots to be optimistic about.
And you talk about regions, and if we break that down further into factors, we know that, for instance, it was growth tech names that were leading and contributing to performance last year. Clear signs now that the value factor is performing well. Japanese value had a double-digit quarter, so up 16%, so that's contributed to global value being up over 6% in the quarter. And of course, one of the standout markets has been Japan, which again, the TOPIX is up 18% year to date. I suppose the one market which has lagged has been the UK, but we're at the end of March and the UK looks set to have to be one of the best returning indices of regional indices for this month. So again reflects that there's the breadth, and also the UK is now catching up to some extent in equity market performance.
Absolutely, and maybe, we often concentrate on equity markets, and I know a lot of clients concentrate on equity markets, and they almost see that as the barometer of how their overall investments are performing. But the way that we invest here at True Potential is multi-asset, so it's using different types of building blocks, and one of those building blocks is bonds, is fixed income. Maybe, Kevin, just to bring to life your thoughts around fixed income over the quarter.
So I think, feeding off your point earlier, Chris, it's probably been the most surprising outcome for the quarter that hasn't adversely impacted returns, which is that markets started the year very bullish on interest rate cuts and very quickly moved to price a lot of those cuts out. So we started the year, as you said, with 6 cuts expected in the UK and the US. We're now at less than 3. And perhaps the most surprising thing over the last couple of years has been how insensitive economies have been so far to the interest rate rises that we have seen in the last 18 months. So we know economies have been affected by inflation, and that has eroded purchasing power for consumers. But interest rate rises haven't had the impact on spending that was perhaps expected. So perhaps we shouldn't be too surprised that when it works in the other way, which is effectively when market interest rates go up a little bit, it doesn't actually impact growth in the same way that when interest rates fall, perhaps didn't have the impact we would typically expect from previous cycles. So this reflects this transition from inflation to growth. Markets more positive on growth, and think perhaps higher market interest rates are suitable if the global economy is going to grow a bit quicker and a bit better, have more breadth than was expected just 3 months ago. So I think central banks have pushed back on interest rate cuts, and the market was already doing a lot of the work ahead of this as well. So we'll likely see some rate cuts next quarter, but they're unlikely to surprise the market. I think we can take most comfort from the fact that all these signals are that the interest rate hiking cycle is over. We are at peak rates. Interest rates will fall, and that's really what's feeding into equity markets. And although bonds have disappointed this quarter, they haven't really detracted from returns, and that's really that starting yield much higher than, say, 2 years ago. I mean, if we go back to just after COVID, the yield on a US Treasury bond was below 1%. Well, it's now above 4%, and that gives you a much higher or future return from owning these Treasury bonds. So there is much to be optimistic about. We've got the growth tailwinds. We're past peak interest rates. We know there are modest rate cuts ahead, and the stock market is beginning to reflect that.
Fantastic. Excellent. Well, thank you, Kevin, and thank you all for listening. Please do like and subscribe to the True Potential channel. Please do tune in to our daily morning markets, our podcasts, and of course, the weekend markets. Thank you.